All right, stocks rebounded today after a couple of down days, especially the roller coaster ride we had intraday yesterday after the FOMC announcement. But as was mentioned yesterday, that momentum of coming back down the hill got us going back up to the upside. Not too great. We didn't bust out to a new bullish move. But there are some positive signs that will continue this rally, especially after the Apple earnings here in the after hours. But we also have jobs report coming up tomorrow morning. So there's some opportunity for the markets to kind of push up to the upside and continue higher. And we'll see if that ends up being the case tomorrow. But there are a few red flags. I mentioned some yesterday. There are a few red flags here from a technical perspective that suggests that there's a pretty decent likelihood. Again, there's never 100% or 0%, but pretty decent likelihood that this rally will fail. I expect that it won't, but we need to be aware of these red flags until they're gone, right? Until they're gone there. And so we're going to break down what we need to see from the market in the next day, tomorrow, or 2 or 3, starting early next week, to really kind of start a new intermediate rally to the upside. And try to get rid of these red flags that are showing up. Otherwise, we need to be aware that there's a pretty decent chance. It's not 100%. It's not even a high probability, in my opinion. But there's a pretty decent chance that we could fail on this rally. So we'll break all that down. The rotation's a much better risk-on rotation we saw today. Gives us good possibilities there. And then our trade idea is a stock that really broke out today on its own earnings to the upside and maybe just starting a new move. And we'll talk about how to trade that. So let's go ahead and get started. Today is Thursday, May the 2nd, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live video. Right, this is where I review old trades, see whether we should stay in them, get out of them or not. Come down to the bottom, click this heart. It opens up this tab. It hits that like button there. Same thing here, click this thumbs up icon. It opens up this tab. Hit that like button. Again, the more you do that, it helps get our content out to all of our followers on those platforms. That's why we always ask for it every day. It's a big deal to us. So thank you to those who like these day in and day out. Those who don't, you can do it right now while you're watching with 1 or 2 really easy clicks. We can try to hit our goal of 100 likes on our Market Outlook tweet. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, we rallied back up again today. Didn't quite get up above the last couple of days highs, and especially what really matters is this high point right here, getting above that 51.23 level, which we might get above here. Let's see if we're above it on SPY. With Apple's earnings out in the after hours, see we're up $1. The key level there is 510, so we have to get above. We're only at 506. We have to get above 510. So we'll see if we get up there tomorrow. If we can get a good jobs report and kind of follow through on this bullishness we're seeing from Apple. The intermediate line turned higher, so we have light green shading again. But we are still in bearish territory. We're still in the lower half of the chart there. Once we get above 50, that light green shading will turn into dark green shading. Most likely will be above the moving average by the time that happens. We are still well below the intermediate line. So any kind of little rally here, when you're below the the market sentiment line, the orange line here, it's still, again, it's still kind of meaningless until we can get a good, strong, like we did get one good, strong near-term rally up, but it wasn't strong enough. We didn't stay up there long enough to get the intermediate line to come up too, this level here. So we're still stuck as the near-term line dropped to extreme lows yesterday. We did bounce back up, but both lines are still relatively muted. We're not really very strong there. Now the NASDAQ looks a little different. We are, a little bit more bullish again because of what's going on in the after hours. If you look at the Qs, we're up to 428. Again, the key level is going to be 433. Yesterday's high point was 430. So that kind of gives you an idea of how much further we have to rally to kind of get above, this little drop that we've had this past few days. You can see again, it's market sentiment is dropping, intermediate lines rising. So probably another good, strong near-term rally into the upper reversal zone might do it. Might be enough to pull the intermediate line up above market sentiment and really get going. Again, that doesn't guarantee. Like this one, we did get above market sentiment over here, and it didn't quite break. So it's got to really follow through. We got that near term line. It got up above, but we got a bearish near term peak next, so we weren't able to stay up, and we can't have that, right? We got to keep following through with good bullish near term peaks, not these bearish near term peaks here. So that's kind of what you look for now, is for another near term peak at bullish levels to kind of support this little rally. The Dow Jones Industrial Average, you can see the short-term sentiment's a little bit better. The near-term line is out of the reversal zone, or out of bearish territory. The momentum line's up in the bullish territory. Market sentiment line's a little bit lower, so is the intermediate line. So you still kind of have about the same distance, just at a lower level on the chart for both those lines. But the idea is still the same, right? Get the intermediate line above market sentiment, and now we have a chance for to turn bullish here. Again, we are more likely for that to happen if you get the near-term line up into the upper reversal zone. What we don't want to see, is a near-term line in the upper reversal zone. Get the near-term line up in the upper reversal zone, and then follow that up with a bearish near-term peak, especially with a bear tag that fails. We don't want to get a bear tag that fails. We want to get a bear tag that we really bust through with here, with a strong rally that we can add and build upon. With the intermediate line really busting through. So that's kind of what we're looking for in the next day or two, right? So tomorrow and then into the early part of next week. If we look at the Russell 2000, you can see a little better short-term sentiment. So the momentum line actually got to extreme highs, which is the 90th percentile to the upside. The near-term line actually got into bullish territory, just barely, really just barely, right at 60 exactly. So it's up there at bullish territory, but again, short term, the intermediate line's rising, but it is below market sentiment still. Is some bearish territory still. So from that perspective, a market sentiment, just like the Dow, is actually below bullish territory, still in the upper half of the chart, but below bullish territory there, and we're still below that moving average. So what we really would like to see tomorrow, really would be awesome tomorrow if we can get a good market response to that jobs number. To build on this Apple earnings response, we would like to get an above average range, bust to that moving average with an above average range, maybe a little bit above average volume, and really feel good about that bear tag that we ultimately would get in that scenario, since we already have light green shading, and of course we'd be that close. Get that near term line up into the reversal zones. I mean, this is what I expect will happen. I think. Again, the other opposite would be that the near-term line would turn right back down here. I don't expect that to be the case. I think when we are, especially on the S&P 500, when we are as extreme as we are, it's hard to stay bearish when you're that extreme. You tend to bounce back up. When you stay bearish is when you get down. Again, you didn't get to extreme levels here, and you just kind of stay down, right? That's when it can stay down there. So we'll see how much more this near-term rally goes, and again, like I said, I expect we'll get back above 80 at least on the blue line, ideally on the red line too, but at least on the blue line, and that will get back above the moving average with a good above average range, good volume, and then we'd be able to bust through and can start a new period of dark green shading and a green line. Let's take a look at the weekly chart. Remember how we have this transition candle right now. The thing is, if we had a really good bullish candle this week, we'd feel really good about that transition candle. Problem is we don't have a good bullish candle. So it means, again, that's something we have to be aware of, that we might actually get another transition candle, and when we get multiple transitions, we end up not reversing, and we just get a new leg lower, kind of like this, right? We just get a new leg lower to the downside. So keep that in mind. As great as it is to have a transition, to have a red, we do have a red arrow again. Now we might not by tomorrow, but we do have a transition. It is a higher close. Hakinashi close, it is a higher low, so that's all fine and dandy. But again, we're not really set up for a new bullish candle next week, right? We'll probably start off the week here at 50.80. That will be the open, and right now we're trading at 50.64 currently. So it's not like we're going to start off next week with a good bullish candle like you would hope when you do get a transition into a reversal. So that keep that in mind about next week. There's it would be like we hope that there's a reversal, and we're kind of leaning in that direction. But right now, this chart's not exactly giving us a lot of confidence for that to happen. Obviously, you don't have 3 red arrows anymore. Your stochastics is turned green. Your MACD is still green on all these indicators. You got to get that 3rd green arrow to really get us going, to get 3 green arrows and a green line. That's what starts it. But again, we've had, a lot of days here without any shading, which is pretty rare when you're bearish, right? When you're bearish, you tend to not get a lot of days. This is about the extent that you get, because you typically go from pink to green pretty quickly. When you're bearish. Now, it's not the case when you're bullish. When you're bullish, you can get long periods of no shading, but not when you're bearish. You tend to get just a couple of days, either turns back to pink, or if we do get these periods, it turns to green. And so, again, another reason why we have a pretty decent odds that we'll turn back to green again, because it's been taking so long. We've had, 1, 2, 3, 4, 5, 6 days now, most likely 7 tomorrow at least, without, if it's not green tomorrow, it definitely won't be 3 reds. So it'll be at least 6, if not 7 days of no shading here, which again suggests that we're probably not as bearish and more leaning towards that 3 green arrows than not. If you look at the 2 line, if I break this out into 2 lines, again, we're still below the 17-day moving average. So it's like, again, we're not only not above the 30, but we're also not above the 17. Now, the 30 is crossing the 50, so that's a bearish sign. So again, we have to break above both those lines, which we would. If we got 3 green arrows, we'd break above both those lines. MACD, obviously, we'd like to get above 0 there. It's working its way up. Stochastics is, we hope for it to get into bullish territory. So it's working its way up above its moving averages. So both those signs are at least moving in the right direction. The DMI is not nearly as bearish anymore. We're still above 25 on the negative. We're still below 20 on the positive, but you can see that ADX really can't get going up above 25. So, again, hardly any kind of trend at all going on here. Your RSI and your CCI, we're kind of in that neutral range, right around the chart's midpoints. Still kind of neutral, coming off of a low, so we need to kind of break out of this neutral range up to the upside to really confirm the bullishness. Your Ichimoku cloud, we're still in the cloud. You're still kind of flirting with both the green and the blue lines here. Obviously, you like to get above that blue line to change the trend, but at least we're above the green. And again, we had we're kind of flirting with intermediate trend strength to the downside, but again, we're just flirting with it. You have a pretty decent negative rate of change. And again, that pink shading is coming up. And we talked about this, I think, in the last video, that, this is the pullback, but plotted forward 26 days. By the time we get to that period, 26 days later, ideally we like to be above it. If we're below it, then we have a pretty good chance that we're going to be in a correction, which this was really very close to being on the cusp of getting in the correction when we broke. It was a correction on the Russell 2000, where we barely broke below the 200-day moving average for a couple of days there on the S&P. Finally, when you look at the Bollinger Bands and the Keltner channels, again, you can kind of see that the band width is falling. The band width is not quite back into the Keltner channels, but that's how close we are to it. The momentum has been waning. It's been yellow this whole time. We still got the green dots, so get the red dots when you get back into the Keltner. That sets up the squeeze play for a reversal back up to the upside. Doesn't mean we have to. You can see we got red dots here and we stayed bullish. We got red dots here and we stayed bullish. But generally, the red dots leads to a reversal, especially when you've been losing momentum like that. We are still in the lower half of the chart. We need to get into the upper quartile if we're going to really kind of turn this ship around here. Looking at the intraday moves, pretty much an inside day today after yesterday's up and down roller coaster. But I talked about that roller coaster where you go up and you go down, and then that gives you the momentum to go up. Remember, right now we're trading in the after hours at 506.49, which is kind of right where my cursor is, right there. We need to get above this kind of 510 level and break through into the upper half of the chart to really kind of feel really strongly bullish. You can see we are barely outside of, we're above the moving average in terms of, again, this is the position of where we are in the 4-week range. and the moving average of that position. So we are above that line, and we are above the 40th percentile really. So we're outside of bullish territory and above the moving average. So again, small seeds of bullishness that could sprout here in the next couple of days. If you look at today's volume, the trading range was a little bit above average. Excuse me, right here. The range was a little bit above average at 6.3 versus 6.1. The volume was a little bit below average. So again, when you're below moving averages, you want to have bigger than average volumes, bigger than average ranges, right? We don't, like you can see the volume on an intermediate decline, you can see the volume really picked up. The volume hasn't picked up on this one. So this has been a very, very weak volume. In fact, when you look at the money flow, when you look at this volume on a normalized basis, I mean, look at where we're at right now. Like if you go back here, if you follow my cursor, excuse me, if you follow my cursor, so here's where we close. If you go back to right about this level, we close at 506 1/4. That's about the closest close we have to the current level in the recent past. Well, if you look at where the money flow was on that day, you can see we rallied from that day up. We rallied, but with very minimal volume, as you can see, and then we pulled back with some pretty decent volume, as you can see that as well. But then you can see on the bounce back up now, we haven't had any volume. In fact, we are when you look at this low point here at 390, we are barely above this low point. Even though we're above it on price, we're barely above it in money flow. So and the oscillator down there is still in bearish territory. So the money flow definitely is not supporting this move, and so again, we need to get bigger volumes and keep those above average ranges so that we can, until we get through the moving average, and then we can start to taper off with volumes coming down and ranges coming down. So a little bit of a red flag there from that perspective. Again, even you can see the ATR didn't get nearly as high, and that was a low level. Right? Remember, usually an intermediate decline, especially one that goes 3 months, will get up to about at least 1.5% on this normalized ATR, closer to 2% more often than not. And we just got up to barely at 1 1/3, and now we're not even getting to 1 1/4 yet. So very weak pullback and not a whole lot of push to get to the upside. You can see that as well in the VIX. The VIX, it didn't go up very much. It stopped short of getting above 100% relative to the VXV. It stopped short of getting to 20. And look at your VVIX is already at extreme lows. So one of two things can happen here. And again, I'm leaning towards the bounce where the VIX will drop down to where the VVIX is, like it did in all these other instances. But right now there's also that possibility, and I've shown you a few red flags here. There's a possibility that that VVIX bounces back up to where the VIX is, and we start to bounce up. So again, I'm leaning towards more of a bullish pattern, but we do need to be aware of the possibility. Again, there's never like 100% odds or 0% odds, right? We need to be aware that there are pretty decent odds, low probability in my opinion, but pretty decent odds that we kind of fail on this little rally and bounce back down. In that scenario, the VVIX would ramp back up, and the VIX, which has been flirting with dropping below its 200-day moving average, will also bounce back up, right, and get back above, get back up towards 20 and so on. But again, we're breaking. I mean, if we can really break this 200-day average, then man, we'll feel really good. Now, there's not a whole lot of downside to it, but at least we'd feel a lot better about being more bullish here. At least a short bullish intermediate rally, which is what I'm expecting, more of a shorter term intermediate rally. All right, now let's take a look at what's driving this price action here. So we'll look at May the 2nd. And you can see very good response in small caps. Remember, small caps were up 2% at one point yesterday before pulling back at the end of the day. Very good response today. Emerging markets rallying. Again, very big drop in the dollar, and that had a big impact on risk appetite today. Gold also dropping a little bit there. They're kind of moving in the same direction. Commodities were up, but commodities have kind of detached a little bit from what's been going on with yields and with the dollar. Yields ended up being down. TLT rallied, ended up being down a little bit too. But really, the dollar was your biggest mover for risk appetite, and it impacted small caps obviously a lot more. Interestingly enough, that's generally not the case, but it did this time, and it really impacted emerging markets, which you would expect. Emerging markets really benefit from a significant drop in the dollar. Let's take a look at the dollar's chart. Remember, the dollar actually rallied last night, but there's your drop below the 17-day moving average, falling below the 23% retracement of this rally that we've been in the retracement mode for quite a while. So you're breaking back down. MACD and stochastics are bearish. So it looks like we're in for a little bit of a pullback here on the U.S. dollar. If you take obviously we're in a near-term decline with the near-term line and momentum line down. Your intermediate line is now below the 80th percentile, so this would not be an intermediate confirmation signal. You got light pink shading there, and you're due here pretty soon for a bull tag. We'll see how that plays out. Your intermediate line still above market sentiment, so you'd have to get that bull tag, break through, and get the intermediate line to break below its market sentiment as well. So not quite there yet. We'll see if we get a little, if this short-term bounces back up. But like I said before, if both of these are extreme lows, you would expect that they would bounce right back up, just like the S&P. But the fact that they're not at extreme lows gives it more possibility of staying down in that level, kind of like this kind of move. So we'll see if it ends up staying down there. And again, a drop in the dollar would help fuel some risk appetite as well. Same thing with the 10-year yield. The more that this continues its decline, also pulling back below that 23% retracement level. The intermediate line almost below its market sentiment line, short-term sentiment bearish. So you can kind of see, again, we're not as close to a bull tag, but you can see the pullbacks going on in both the dollar and the 10-year yield. That's working in favor of stocks right now. Remember that I've told you before that the market doesn't like falling yields. The market, like in the short term and a small move, they like ultimately when yields really start falling across the board. Then, because like right now, when the 10-year and the 2-year drop, the 3 months not dropping. It's been flat. In fact, the 3 month has been flat for a very long time. Eventually, it will come up here. So that when this starts to drop, when yields drop across the board, then that is not, like I said, stocks don't like that. Stocks like low yields. They don't necessarily like, I don't know why it's not showing up there. They don't necessarily like falling yields. But in the short term right now, in these short moves, they do, right? The market is preferred. I don't know why it's not showing on these charts. But it is like, and a lot of the short-term moves has to do with interest rate cuts being on the table. The market doesn't like, again, once they start cutting rates, yields across the boards fall, and that's not, and interest and the inverted and the yield curve or spread starts to rise. And again, the market doesn't like, stocks don't like that. But in the short term here, when that yield curve rises towards zero, that's okay. When these short-term rates fall, but we're not cutting, that's okay. When the interest rate cut odds ramp back up again, but not up to like 100% here in the short term, that's okay. Like for September, you can see we only have a 38% chance of not getting a rate cut. So it's jumped back up to, it's come back down from 46 here yesterday, where we were close to about a 50-50 shot of getting. So right now you're back up to about a 63% chance of a rate cut in September. I don't think we'll get one, but you can see how the odds are ramped back up. Here a few days, we were in the 20s a few days ago on this, close to 25. Remember I said that we have 1 in 4 chance we don't get a rate cut at all this year? Well, we just cut that in half. We're back down to 13% of not getting a rate cut. So the market loves having rate cuts on the table, but it doesn't actually, we don't actually want it to happen. We like this cycle of rate cuts coming on the table and then coming back off the table and coming back on the table and coming back off the table. Because every time they come back on the table, we get higher highs. Every time they come off the table, we get these pullbacks. But as you see, the pullbacks have been very, very minimal when you look at here the last so many that we've had. So again, we back at the end of 2022 is when we first started pricing in rate cuts in 2023. the market rallied 14%. And then we had the pullback when it was like, maybe not. But then it started ramp up again, rate cuts. And it was like the summertime that we were going to get rate cuts. But then we had the banking crisis, right? And then with the banking crisis, like during this pullback, rate cuts came off the table. But then we had the banking crisis, and rate cuts really came back on the table, and we had a 19% rally. Then we had last summer where rate cuts came off the table. Then they came back on the table at the end of the year, and we rallied 27%. So as long as we don't ever actually have rate cuts, but they're still on the table, we can get these good runs. And when they come off the table, like they just did here in the last couple of months, we've been getting these kind of small little pullbacks to higher lows. Perfect. Right now, eventually, that happened in 2007 too, and eventually they did cut rates in September of 2007, and we started the cycle, and yields started to fall, and then we all know what happened afterwards. So, like, if we can push that off, to at least 2025, which, I think would be the earliest we get kind of any kind of bear market indications. But if we can push it off to even further, 2026, 2027, I think that would be the most ideal scenario. Back in 1995, we pushed off falling yields completely and ended up pushing it off until 2000, right? Then we got the 3-year long bear market. But at least we were able to push it off, for a few more years in that scenario. And that's kind of what the hope is that we can do here. We can keep them on the table, use them when needed, like in a mid-cycle adjustment, kind of like 1998, but then get them back on and then start raising rates again, get the rates back up, so without falling, and then we'll see what happens later. But hopefully we'll be at a much higher high point by the time that scenario plays out. So we'll have a lot of profits that we can be able to book before we get kind of more of a longer term pullback than only just 5% or even 10%. Let's take a look at how the sectors are moving right now. And you can see the comparison chart here today. We'll take a look at today. Energy, which was down a big yesterday, and that was our trade idea. Energy, you can see, was doing better today. Not outperforming, but at least it was up. You can see utilities, again, not outperforming. It's been bullish, but it was up. Staples as well. Staples kind of pulled back at the end of the day. Technology and discretionary are big winners, along with real estate. Real estate's, again, kind of behaving like a cyclical stock here. It really rebounded pretty well too. There's XLC also outpacing the market briefly. So your big three, along with real estate, kind of like your big four. And then you can see, if you look at the rotation into you can see utilities and staples dropping, healthcare dropping, discretionary real estate rising, moving over to the left, technology rising, communication services not so good, energy really pulling back here, hence that trade idea. But at least it looks like we're kind of moving in the right direction to bringing these safety trades back down and bringing these cyclical areas back up to the top and to the right. So we're potentially rotating back into favor there. Again, the key relationships here to watch are XLK getting back above its 17-day moving average, getting above, showing some bullishness there, and then XLU starting to show some weakness. It's got so much strength right now. I mentioned yesterday that we had finally broken above the 200-day moving average on XLU relative to SPY. We're still above it. So this needs to be a fake out, right? We need to break back down and not continue this move up to the upside. Same thing with XLK relative to SPY. It has already broken its 200-day. Hopefully this is a fake out. We need to get back above that 200-day because this is very ominous. The more we stay below that. And the same thing with XLY relative to XLP, right, having already broken its 200-day too. In fact, you're almost that close to a death cross on there. And then what we really want to avoid too, breaking the 200-day, is the Qs relative to IWM. So we're still holding strong, which is a good sign. Break that moving average, and now this moves lower and this gets below zero. The long-term PPO, that typically occurs with weakness in the markets, not strength. So we we're limited on the upside. So any new intermediate rally we get may not last very long. The typical range is 1 to 3 months, so maybe more on the 1 month side of things. Probably won't go up 19, 27%. But again, if we can get 8 to 10%, that'd be great on a little bit of a rally here. But at least we would avoid any kind of, because again, there's a few little relationships here that are showing some really big red flags. We need those red flags to turn out to be fake outs there, so we can get this new intermediate run started. All right, now let's take a look at our trade idea for today. So it's actually on Moderna. Moderna had a really good reaction to its earnings report. Big breakout move today. You can see breaking up above some prior highs. If I were to zoom out a little bit more, so we can kind of see that Fibonacci level. It's kind of this first initial drop in 2022. We continue lower. We're back up above that 2022 low point now. Back above this bear tag. You can see on a weekly basis we got this bear tag back in the first week of 2024, but then we didn't build on it and we just kind of went sideways. Well, now we're closed up above that high point, almost with a cluster on the weekly chart too. So really good move from that perspective. If you look at this weekly chart, you can see that we got a good bullish candle. Again, the Hakinyashi closes above all these candles too, so that's a positive development. And you have a golden cross, right? Your 10-week moving average. Not only have we crossed above the 10-week last week and the 240 week here, which is like, again, the 50 and 200 day proxies for those, but now the 10-week is crossing above the 40 week. So good bullish move there from that perspective. Obviously, you have 3 green arrows. You have pretty decent volume today with the earnings. There's your breakout getting above the value area. So we really kind of broke out of this big volume node, kind of achieve hopefully some escape velocity there. When you look at some of these other oscillators, big bullish move on the DMI, and the ADX is still below 20. So maybe just getting started. Big bullish move on the RSI and the CCI, getting up above 70 and above 200 there. So again, last time we got above 70, it was a result of kind of an extended move. This one, it's a breakout move that got us above 70 and above 200. So good opportunity there from that perspective. Looking at the Ichimoku cloud, you're obviously going to be up above the cloud. And again, strong rate of change to the upside. You have intermediate trend strength already with this move to the upside. Again, last time we were already at a mature trend strength when we got that high RSI and the CCI. So we're just starting here. And then a big breakout of the Bollinger Bands. All right, so we ended up way outside the bandwidth. The bandwidth is really small. The range, the 150-day range of the bandwidth is really big. So we got a lot of movement we can move here. Also getting outside the Keltner channels. Again, we were outside the Keltner channels there, but we had already been outside and outside the bands. So this is kind of like, that was a culmination move there at the beginning of the year. This one's not so much. This one looks like we're just kind of getting started with a breakout. The bands themselves were flirting with a breakout all day today. We finished without one, but we're most likely going to get a green dot tomorrow, which means, again, the bands are breaking out of the Keltner channels tomorrow. So good opportunity here. Very good opportunity for a bullish trade. So I was a little bit more aggressive on this one. I decided to give it a little bit more time, go out to beyond that 50-day mark, the June contracts. We went out to July, bought a long call option, and with a stop order right around the 50%. It was, at the time, it was right about at the money. You can see now the 125 is at the money. But you can see that here's our trade, and with the stock moving up to the upside. If we do get to 1 standard deviation by July expiration with about a $500 risk, we get about a $1,500 reward, again, within 1 standard deviation. So a good risk reward and an opportunity to let what may be the beginnings of a new trend on this stock, see how long it lasts and see where it can get up to, and see if it ultimately gets to new 52-week highs and then some. Because again, remember, on a longer term basis, just getting back to 200 would be a big deal, back to these old 2023 highs, and that would be, again, for a $500 risk, you're looking at about a $6,000 reward. So that would be a really good reward to risk ratio, over 10 to 1. Of course, if it makes it up there, we'll see if that ends up being the case. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen that takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at marketscholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Thursday night, everybody, and we'll see you all tomorrow.